Hello and thanks for joining us at interest.co.nz. I'm Jenée, Tibshraeny, and today I'm at the Reserve Bank with Deputy Governor Geoff Bascand. Hi Geoff.
Good morning.
Just this morning the Reserve Bank has made a few massive announcements. Firstly, to cut the OCR by 2.25%. This will take effect tomorrow and be in place for a year. And then the Reserve Bank has indicated that the next move, should more monetary stimulus be necessary, would be large-scale asset purchases of New Zealand government bonds. I was interested that you said that banks aren't ready for negative interest rates. What would banks need to do to get ready for that?
Well, it varies by institution, but in broad terms, they've got to be able to have systems that can put negative rates into them and have all of their legal documentation with people they transact with being able to cope with negative rates. The particular problems for a number of them is that their IT systems aren't ready and can't cope with negative rates.
Okay, this doesn't make me feel particularly good. Why are the IT systems not ready for that?
Well, I guess New Zealand hasn't really contemplated negative rates in the historical period that we can think about, and so it's a bit like a Y2K thing in a sense that they were all set up to be positive, zero or positive numbers. So it doesn't mean that you couldn't create some workarounds eventually or adjust this, but right now it doesn't seem to be the key thing to do. We've got other ways of putting stimulus into the economy if we need to, and taking on additional risk of doing something that may or may not transmit or work properly at the moment doesn't seem the smartest thing to do.
Okay, for that bond program to kick in, what would be the tipping point?
Well, I don't think we want to sort of indicate there's one particular trigger. What we do all the time is assess whether the stimulus we're injecting is helping to support the economy, not just what we're doing, but what the government's doing through fiscal policy and so forth. So we'll come back and reevaluate this on a regular basis and understand how big the shock is, what's needed to help build confidence and support employment and activity.
Banks at this point aren't asking for further liquidity or support, but the Reserve Bank has said that it will be there if that's required. No doubt you're watching what's happening around the world and all of that. How far off might we be that point where banks will say, actually, I think we do need some liquidity support?
Well, we're starting into this difficult circumstance in a very well-funded position. Banks have got way above what's called their core funding requirement, which is stable longer-term funding. They're well above that, so they're funded well out for over a year or more in terms of that requirement. But they also have shorter-term funding requirements. The short-term looks absolutely fine for a couple of months, maybe more, or whatever. So it all depends really on how markets function over the next few months as to whether at some point you get a little bit of dislocation or some terms of borrowing aren't available to them, whether it's a 3-month note or something or other of that sort. So we stand ready there to help them if they need that, but at the moment it looks absolutely fine in both the short and the longer term end of their funding markets.
Sorry, you mentioned a couple of months. Could you just explain
what I'm saying is banks have funding that matures. Sometimes a lot of it matures the next day. We have 1 day funding, 2 days funding, 3 days, etc., 30 days, 60 days, 90 days, all the way out over a year, 5 years, 10 years. So when we look at all the numbers, they all look good, but I can't predict exactly what will happen in 3 months' time. So in 3 months' time, some of that shorter term funding might be harder to replace.
Sure.
Right?
Yeah.
It's not the big part of their funding, but it might be part of it. So we just stand ready to adjust if we need to.
Okay. On the bank capital and the change, so previously banks had from July 1, they had 7 years, just for people listening, to implement new capital requirements. That's to make them much stronger, and the Reserve Bank has today said they will be given another year before they have to do that. How did you get to the figure that you got to as to how much more headroom that will give banks to lend?
Well, we worked out how much capital they thought they were likely to have to raise, and what that implies in terms of the lending that it's associated with. So, look, it's an estimate, but
47 billion.
Yes, yeah, or about over 1.5 years of credit growth, or whatever else. So they're not having to put that extra capital in, and this was coming in different ways, from adjustments to their required models and total level of capital that the big banks had to have. So yeah, it's an estimate, but we think there's a lot of headroom there for banks. They're well capitalised. The key thing is that they're already well above their required levels, and we always said that they were quite close to what was going to be needed. So instead of raising capital, which they would have had to do, now they can use the capital they've got.
Okay. This morning, the Reserve Bank also said that it's identifying other regulatory initiatives that can be deferred for banks. What are these? Can you give us an indication?
Well, let me just start by saying, for the whole financial sector, not just banks, we'll also look at insurance as well. But look, there's lots of work on the regulatory agenda, if you like, and they range in different scale. So by putting off the capital review means we don't actually consult over the capital instruments and the capital handbook, so that gets pushed off. But we also look at other things like reporting requirements that we were consulting on, and we'll go through a list of that, and we'll communicate with industry and with our other regulatory partners in the next few days about what we think should be deferred.
Insurers were in for a capital review as well this year. Will that be deferred?
Well, that's one of the ones that we've got to look at. There were a number of things that in the insurance area. We were looking at opening up the Insurance Prudential Supervision Act, IPSA as it's called, as well as looking at their solvency standards. There is a reason to look at the solvency standards, because new accounting standards are coming in next year, and so at some point we have to adjust the solvency standard to take account of that. So we've just got to work through what's should still be done and what should be held off, but it certainly includes those to be looked at.
Are you a bit concerned that before coronavirus, the Reserve Bank mentioned the impact that the low interest rate environment was having on insurance companies that have, big investments that rely on certain returns, and they've been lower for longer, and no doubt that would have been factored into reviews around capital. Are you a bit more concerned now, given we are in for a very low interest rate environment for what will be a much longer time than previously thought?
Well, that's part of the job that we do, which is to try and work with that industry and understand how resilient they are to these changes. We were doing that because we said there was a possibility that interest rates might have to go down lower, and we're now in those circumstances. Insurers are also going to be, some of them, the life insurers, could also be hit by higher mortality rates potentially, or health insurers hit by greater morbidity, sickness and illness. So that's one of the things you want all of your finance sector to have enough resilience to these events. So it's like capital buffers, it's having insurance buffers and so forth. I think the big message overall is it's in a good stage, but there are some insurers that we're working with to make sure they've got enough buffers there, and sometimes we've talked with or imposed conditions on individual insurers to make sure they hold a bit more capital to make them stronger.
Okay, why, just to jump to something else, this morning, why did the Reserve Bank not provide forecasts for GDP or economic growth?
Because they might have been outdated by this afternoon. Look, the challenge is really very hard to put meaningful forecasts together in these circumstances. We actually had some provisional scenarios and which, if you like, different sets of forecasts on Friday. Then the government brought on a different travel, restrictions on Saturday, so they're immediately out of date. So, we're just creating noise rather than information at this point. What we're doing is saying we know this is going to be a hard impact on a lot of businesses and a lot of households, hard impact on the economy. We've got time to spend a bit more effort to try and quantify that over time. Even then it'll be difficult, but not today.
Sure, and in all fairness, a figure right now is not going to change the reality, is it? Okay, in terms of depositors might be worried that if the bank collapses, at this point there's nothing that means the bank has to give them their money back, right? And there's legislation going through Parliament, consultation underway to introduce a deposit protection or insurance regime. And the way that works is that banks will pay levies into a fund, and then if a bank collapses, depositors will get a minimum amount of their money back. But that is still a wee way away. What's happening with that now in light of what we're dealing with here?
Well, look, the big message is the banks are well capitalised. So let me say that they are in a strong position. I mean, this is not the GFC at this time, right?
Yeah.
That was a really significant financial sector shock. This is going to hurt some businesses and households, but the banks are actually in a strong capital position, so people should feel safe about that. The system is sound, and if it needs some funding, we can help it with the funding in that liquidity sense. But the deposit insurance scheme is something that the government's committed to, and details of that are still being worked on and still to be are being consulted on further, and we will continue work on that as the government prioritises amongst all of the things we've got to do.
Can you introduce some sort of a protection scheme without it going through this quite sort of long process, through the legislation?
Potentially, a guarantee scheme was created during the GFC, so it's possible. We don't have any plans to do so at this stage because we think the banks are in a sound and strong position, and it's not a financial crisis that's affecting banks all around the world. It's affecting the real economy, households and businesses.
Okay. Deputy Governor Geoff Bascand, thank you so much for your time, and I'm Jenée Tibshraeny from interest.co.nz.